Okay, hello everybody. Let's see here. Let's make sure we're all set up on all the different gadgets. Oh, it looks like we are still loading on Facebook. All right. So welcome everybody. We are, let's see here, June. We're still in June. Oh, take that back. Okay, we are in June 24th, 2024. So welcome everybody. So we will get started right now. And I want to spend sort of the next 30 minutes going over a calculation that came up during an investor presentation that I did yesterday about how the ROI was calculated on a current project that I'm working on. And so, of course, it is just a projected outcome, but I wanted to sort of break it down a little bit more on today's session. Okay, so I'm hoping, from these sessions that, I am able to share my knowledge and my experience with fellow accredited investors so that we can all make very sound decisions with our money with confidence. Okay, so before I go into the calculations, I want to do a shout out to the potluck group that I had over at my place this past weekend. And so I just want to thank you everybody for coming out. And, it's amazing being in a room full of like-minded individuals who are open to talking about money and investments and, just sharing what we're working on and just sharing the ideas and mistakes that we've made on the way in our real estate journey. So thank you everybody for coming. There's actually quite a bit of people, so I'm actually not going to name everybody here because it was quite a lot of people that was at the place. So thank you. You know who you are that showed up. So thank you very much for that. Okay. Oh yes, I am on Instagram now. So I am doing the 90-day Grant Cardone $1 million business creation. So it's a business evaluation. So of course I'm using real estate. So if you want to follow me on my journey, I am on day 24. So it's going quite fast. So if you want to follow me, the Instagram is Cash Property Canada, all one word, okay? And it's Cash Property Canada, so you can't miss that one. So, all right, so we did the welcome. Oh, disclaimer. Before you go and implement any of the stuff that I'm talking about, please do talk to another investor, talk to your financial advisor, accountants, and lawyers. Just make sure that it's right for you. Okay, so, oh yeah, I have a note here. Today is the last day for the old capital gains inclusion. And so we're actually switching over to the new one tomorrow. So hopefully if you've got an investment property or something with capital gains, that applies to capital gains. I hope you got that resolved today and it's done, because otherwise you will be transitioned over to the new capital gains. And it's not prorated saying like, hey, whatever the gains, like it's not drawing the line in the sand and saying that it's prorated from tomorrow and, the gains from tomorrow is at the higher rate. It's everything from day one in terms of your gains. So and the reason why I bring that up, because, with some of my properties, I've had them for 20 years. And so there's been a lot of gain in those properties over 20 years. And so I will be hit with this new capital gains inclusion from day one of that purchase, not from tomorrow's date saying whatever the gain is from that date. So it's a bigger hit. It's yeah. So you definitely want to plan around that and make sure that you have the funds to cover your capital gains inclusion tax when they are due. Okay, so let's go into the calculation of the ROI. So on the current project that I'm working on, it's more of an equity play as opposed to like a cash flow play. So the cash flow is very minimum. What we're doing is we're doing an equity play, meaning that it's counting on the cash flow, mortgage pay down, and the appreciation. The three of those things combined is what our future equity is going to be. So every single year, to calculate our ROI, we take those three things and we add them up and we say, okay, based on how much money we've invested to get into the project, what is our ROI? So let me share with you my my spreadsheet, okay, and then that way you can see how some of that is calculated out. Okay, sorry. So I've got I'm calculating some RSPs, withdrawal taxes and stuff like that. So I've got that open, and I really should close that down. But in one of the future sessions, I will definitely share how that calculation works out. All right, so on the screen, you should see, let me just make this a little bit bigger. Okay, so here's an example of how the ROI would be calculated. So what I've done here is I've just said, okay, assuming that we invest $100,000 in. So the ROI isn't going to matter if you invest 200,000 or 300,000. The percentage ROI is actually still going to be the same. Okay, but what it is that the dollar value will be higher. Okay, so I'll show that what I mean by that. So here it's 200. Based on some other calculations, we have an ROI here of 43. Okay, so I've been playing around with this spreadsheet. So this is not the numbers for the current project I'm working on, but the idea is the same. Okay, so keep in mind that ROI is a projected number. It's not guaranteed. There's so many things that affect your ROI in terms of, okay, well, what's the vacancy? What's the rental income? What's your expenses? What's the mortgage? What's the debt servicing on it? So there's a lot of other factors that come into play with your ROI calculation. So just keep in mind that, your ROI it allows you to compare opportunities, but it's not set in stone. Okay, so the one thing to point out here is that, so this at 100,000, you would be looking at an ROI here of 43% and a dollar value of 16,000. So if I increase this to, let's just say 300,000, okay, you can see that the percentage here doesn't change, right? It's actually still the same percentage in terms of ROI. But now the dollar value has gone up because you've invested 3 times as much money. So your return in dollar value would be 3 times more. So you're 3xing, okay? So that's one thing to keep in mind. So let me just go back to the 100,000. Okay. So in terms of calculating ROI, let's look at this table down here. Okay, so what we're doing is we add whatever the cash flow is, the mortgage pay down, and the appreciation year over year, and we're doing this for 1 year. So we're actually, we're calculating on a year by year basis, okay? So because this is an equity play, meaning that the money's going to stay in the project, and in this case, if our mortgage duration is 5 years, like, so we have a 5-year term, then the equity play is going to be for a 5-year period. And so whatever your cash flow, principal pay down, and appreciation all accumulated in that 5 years, that's the amount, okay? Then you take the 5-year accumulation and you divide that by 5, and that is going to be your ROI per year that you would anticipate getting. Okay, so in this case, what we did was we took the 5-year frame. So what we did was we said up here, okay, so this part down here, it's already broken down by the year. And so what we're saying that even though it's a 5-year term, each year we can anticipate getting $10,000 roughly, okay? And that $10,000 is made up from the cash flow. In this case, about 1,200. The mortgage pay down is just under 1,000, so 800, so not very much there. So I'll have to go back in and check out why that is. And then the appreciation, which is the passive appreciation or natural appreciation. In this case, we're running it with a 4%. So in this calculation, we're using 4%. And so from that, that's how the sum of those 3 things adds up to your $10,000. Okay. And so based on the numbers, that's roughly about an 11% return. Okay. So I'll explain how that's calculated as well. So in the in my particular project, what we're targeting is we're targeting to return this 100,000 within 18 months. So let's just say that, you know, it takes us 18 months to 2 years. Okay, so you get this 100,000 back. Okay, well, after that, you're going to be getting roughly about $10,000 in equity, okay, throughout each year for the 5 years, okay? But at this point, you don't have any money in, okay? So usually the calculation for something like that is where you don't have any money in, but you're making a return. That's where that concept of infinite return comes in, because you have no money in. You've already gotten all your capital back, okay? Now, let's just say if after the 18 months or the 2 years, you get 80,000 back. So your 100,000 wasn't paid back all in full. If you still have money left in there, okay, then that portion of the money, that 20,000 in this example that I'm talking about, that 20,000 would be considered the investment money you have left in. And so when you calculate your ROI for, let's say, 1 year, you would take this $10,000, divide that by your 20,000, let's just say if that was left in. So I'm just going to go here and go equals. Can I do an equal sign? Nope. Okay. I don't know. For some reason, I can't get an equal sign going here. So if you are following along, 10,000 divided by your 20, which is the investment that you put in, then it's about a 50% return for that first year, or for that 1 year. Okay, so how did we calculate this 11%? Okay, so the way that that's calculated is based on, okay, now I can also move my screen up. Okay, so let me unshare, because I think there's a bit of a hiccup on one of my screens. I'm gonna shut down that RRSP sheet that I'm not using right now. So that way it freezes up any potential issues here. Okay, let's see if I can move my sheet. Okay, yeah, so I think that was what the issue was. For some reason, that other RRSP sheet that I was working on was freezing up my sheet here. So let me reshare. Okay, I don't want that one, and I want this one here, calculation. Okay, so we're back to the calculation again. All right, so if you take this 10,000 and you divide it by your 20, okay, and actually, you know what? I'm just going to put this cell down here, so that way you can change it. So if you do that, then you can see that your return for the 1 year is roughly about 53%. Okay, so that's actually amazing. Okay, now, however, if you don't get any of that money back and you left 100,000 in, let's just say, then you've made about 10% on your money. So that's still not bad, but it's not ideal considering we're projecting, you know, pretty much a full return of that capital. Okay, so now in terms of calculating the ROI breakdown for the shareholders in this case, because we're doing a shareholders agreement, each person is going to get a portion of the equity share. Okay, so we're raising about 1.62 million. So I'm just going to type that over here so you could follow along. Okay, so in this case, we're doing a 40% shareholders for the investors. And you might think like, oh my God, 40%, that's not very good, because some projects it's 50-50, some projects it's a 60-40, 60% for the money partners. Okay, so in this case, we're doing 40%. But if you come in by a certain date, then you get some bonus equity. Okay, so I'm just going to put I'm going to assume that people are coming in early and getting the bonus equity. Okay, so I just want to show you how this calculation would work out. So based on this bonus equity of 45% for the shareholder, okay, they would, in the cash flow for 1 year, we would be looking at a total of $50,000 roughly. So they would get 45% of that 50,000. Okay, so the project is going to make roughly about 50,000 in cash flow. Okay, the Okay. And then there's going to be a $35,000 pay down on the principal mortgage. Okay. And over the course of the 5 years, over the course, there's going to be a 4% passive appreciation or natural appreciation in this case. Okay. And so that's going to be about $344,000. Okay. So then you do the math on that and you take 45% of all that. Okay. And so then that's where you get the percentages for each one, and you just take the let's say the 22,000, which is 45% of the 50,000, and then you divide that by the total of that return. So this 194, and that's how you get your 1.53 percentage. Okay. So you do that for each of those three numbers. Okay. And then the combination of that, the sum of that is how you would get, in this case, 13%. Okay. So as I mentioned, depending on what your factors are for your cash flow, what your terms are for your mortgage, and then what you consider for your natural appreciation, that's going to affect your ROI for the project. So let's just say, in Vancouver or Toronto, where we've seen higher appreciation, let's just say we get 8% appreciation. Okay, well, look at the ROI, like it's completely changed, right? Or if we know that our cash flow is going to be a lot higher, and let's just say we're making 120,000 from our cash flow. Let's see, is that 120? Okay, well, then that changes that percentage, that component of the ROI. Okay. So as you can see, playing with the spreadsheet is very easy to like forget where you made a change. And so it's always like, so what I like to do is go back and just make sure that I go back and adjust things as needed. Okay. So to the point where I like, okay, that's still a good number to work with. Okay. So that is how the ROI is calculated for a project in terms of cash flow, appreciation, and mortgage paydown. So when you're talking about a project return, in this case, you would say, okay, the project is going to give you 13% year over year. Okay. And then you sort of need to consider, okay, well, when are you going to get your capital back? So, if you're not able to force the appreciation within a year or two, like in our case, we're forcing the appreciation quite a lot to be able to recoup our capital investment. If you're not able to do that, then you have to wait the 5 years until you refinance to be able to recoup all of this profit and then to be able to pull it out. Okay, so let's see here. So I just want to make sure that we consider all the stuff. Okay, the other thing I want to point out is the splits. So if you are coming in and you have the full 45%, then you know that this entire amount is going to be your gain. Okay, so what I've done here in this calculation here is that I've already done the split on the 100K. So that means that of the 45% of the available cash flow going to the money partners, you're going to be getting, in this case, 1.5% of that 45. Okay, so I hope you follow along on that one. And then in terms of the principal pay down, you're getting 1% of the 45%. Okay, so in terms of your 100,000, that's how you're getting your 13%. So this 13% is not split with anybody else. That is your individual ROI percentage return based on the amount of money that was needed to execute on the project, based on you putting in 100,000. Okay, if you put in more money, okay, so let's just say we go back to the 300,000 here. If you go back to, if you had put in 300,000, your percentages, your percentages would still be exactly the same, but your return now would be 3x that, okay? Because it's based on the amount of capital that was needed to execute on the project, okay? So let me see. What else do I want to mention to you? So we mentioned about the infinite return, because if this 300,000 is returned back to you after the 2 years or the 18 months of construction, then you have no money in, and then it's infinite return. Okay. All right. So let's go back here. Let's see, what else can I mention to you here? This number here, let's just say, so you invested 300. At the end of the 18 months or 2 years, we return 200,000, but only 100 is left in the deal. It would be a 32% return. Okay. And what that is saying is that each year, roughly, you would be seeing about a 32% return on your money, because you only have 100K in. So at this point, it's not infinite return, okay, because you still have 100K left in there. So then in this case, what would happen is we would wait until the 5 years to refinance and pull out the equity. Okay. And with the equity, there would be the appreciation, the mortgage pay down. And so that should be enough to pay back your 100,000. And then after the 5th year, then that's where you would have infinite return, because now you have no money in. Okay. So that's how to look at the infinite return with the ROI. Okay, yeah, and then you definitely get to keep the equity as long as the property is held, right? So the minute you sell the property, then it's no longer infinite return for anybody, okay, at that point, because you sold the property, you recognize whatever the purchase price is, and then the ROI stops, and then there's no more return on the money. Your capital is returned, but there's no more infinite return or no more ROI on your cash. Okay, so the other thing is, because this is an equity play, meaning that there's a lot more gains to be seen from equity rather than the cash flow play. Okay, so that's what it means by an equity play. So in some properties, okay, especially if you've had them for a very long time, there's a lot of equity in properties that are potentially considered dead, like dying, dead, not debt, but dead equity. Okay. And that's usually a bad thing, because you have equity and you're not able to use it. Ideally, you want to refinance, get a second mortgage, get a private, be able to leverage that equity in some way. Okay. So because it's buying power, right? So if you're not able to leverage that equity, then it's considered dead equity, and it's not ideal. Okay. So one way around that debt equity is, if you can't leverage it, by pulling more cash out, by refinancing or getting a second mortgage, then the other solution that not everybody will be able to tap into, even if you have equity there, is doing what's considered loan sponsorship. Okay, so if you've got actually quite a lot of debt equity in your portfolio and you have a high net worth, you can potentially loan sponsor some of that equity and use it to your benefit. Okay, so if you need more information about that, please feel free to reach out to me. My meeting QR code is not available. I just realized that. So you are not going to be able to reach out to me if you don't already have my email address. But if you reach out to me on the Facebook chat or on the YouTube channel, then you can definitely reach out to me that way. Okay, and I will see if I can get my email linked in there. Okay, so let me unshare. So thank you everybody for watching. I will be back next Monday. Next Monday, with some more calculations. If there is a calculation you would like me to run through, please email that to me and I will tackle that in some way. Okay, so like I said, one of the things I'm calculating out right now is like how our RSP withdrawals are handled. And so at some point I will share that with you as well. Okay, thank you everybody. Have a great day.